I want to open with something I have learned from decades of studying markets, and it is a principle that cuts equally in both directions. The same clarity of thinking that allows you to stay calm during a sharp decline, to recognize a correction for what it is rather than panicking as if a structural bull market has ended. That same clarity of thinking must also function when a market bounces. Because bounces inside corrections are not new uptrends, they are relief rallies. And the investors who mistake a relief rally for the resumption of the primary trend are setting themselves up for the exact same kind of pain as the investors who panic sell at the bottom. Gold and silver have bounced significantly. The lows we saw several weeks ago were genuine oversold conditions, and the rebound from those lows has been real. But we are now approaching a zone where the honest technical read demands more caution than enthusiasm. I am going to tell you exactly where that zone is, what the historical structure says about it, and what the two scenarios are from here, because in a market like this, holding both scenarios clearly in your mind is more useful than forcing false certainty in either direction. Be careful. Not panicked, not bearish in a structural sense. Careful, which is a different thing entirely. Let me explain why. Let me start with the structural framework that has guided my analysis throughout this correction, because it is what makes the current moment legible rather than confusing. There have been three major breakouts in gold's modern history. Not many, three. Each was followed by a significant correction before the next major advance. When I map those corrections against each other on the same scale of time and price, a consistent internal structure emerges. It is not identical across instances, markets never repeat precisely, but the pattern is coherent enough to be useful as a guide. The structure shows three phases. First, a sharp initial leg lower from the peak. Second, an oversold bounce and rally, a relief move that recovers a meaningful portion of the prior decline. Third, a final leg lower that roughly retests the first low, followed by a durable bottom, and then the resumption of the primary trend. Where are we right now? We are in the second phase. The initial low was established several weeks ago at a timing and price level that was consistent with where the prior analog corrections had bottomed in their first leg. We called that bottom. The rally from that low has been substantial, and we are now approaching the area where, in the historical template, that rally tends to exhaust before the final leg lower begins. I want to be precise about what I mean by careful. I am not saying the correction is going to be catastrophic from here. I am not saying the structural bull market has changed. What I am saying is that the risk-reward for adding aggressively at current prices is not favorable, and that the investors who are treating this bounce as the beginning of a new uptrend are likely to be disappointed in the near term. The correction is probably not over. It is probably in the process of completing. And that process likely involves one more phase before the genuine buying opportunity emerges. Let me be specific about the levels, because this is where the framework becomes actionable. For gold, the recent rally has carried price up to approximately $4,133 at the time of this video. The character of that rally, the pace, the candle structure, the volume pattern, does not look impulsive to me. When a market transitions from correction to new uptrend, the price action typically has a different quality. It is decisive, directional, and accompanied by expanding participation. What we have seen in this bounce is grinding, hesitant, and lacking the accumulation characteristics that I associate with genuine trend resumption. The resistance zone I am watching is $4,900 to $5,000. That is where supply is going to meet this rally. Multiple prior highs, multiple failed attempts to sustain above that zone. This is where sellers are waiting, where traders who held through the correction will look to exit, and where the burden of proof shifts back to the bulls. There are two scenarios from here, and I want to lay both out clearly rather than pretending I know with certainty which one will prevail. The first scenario, the one more consistent with the historical analog, is that the rally exhausts somewhere in the $4,900 to $5,000 resistance zone, price rolls back over, and we see a final leg lower that roughly retests the prior low before establishing the durable bottom. That bottom, based on the temporal framework I have been tracking, would likely form by late June. The implication is that the real buying opportunity, the one that precedes the impulsive move higher into new all-time highs, is still ahead, not behind us. The second scenario is that gold is able to push through $5,000 with conviction, establish that level as support, and consolidate above it for several weeks before continuing higher. If that happens, the correction structure looks different, more like a complex consolidation than the analog template, and the market would be telling us that the bulls have more strength than the historical comparison implied. I would not fight that message if it comes. Right now, the evidence favors the first scenario. But I hold the second scenario clearly in my mind because being wrong about the direction of a near-term move is not a failure. Ignoring the signals that tell you you are wrong is. Silver deserves a separate discussion here because its technical picture is actually somewhat more constructive than gold's at this moment, and that distinction matters for how you think about the two markets. The recent price action in silver has been notably stronger than gold. Where gold's rally has been grinding and hesitant, silver has shown more relative strength. Silver has also produced better candle structure over the past several weeks, clean bullish hammer reversals at the lows, followed by sustained follow-through. Let me explain why the candle structure matters here. Silver tested a key weekly support level twice in recent weeks, both times producing bullish hammer candles, where price made a significant intraday low but recovered to close substantially higher. That pattern, appearing twice at the same level, suggests that genuine buying interest exists at that support zone. It suggests that sellers who have been pressing silver lower are encountering real resistance at that level. The resistance I am watching for silver is $81, followed by $90. Silver has pushed to approximately $80.75, essentially testing the first resistance level with precision. Whether it can break through that level cleanly is the near-term question. Here is something I want to say about silver that I think is important context. Silver has already experienced a 50% decline from its recent peak to its recent low. That is a substantial amount of price damage. The question of how much additional selling pressure is actually available to drive silver significantly lower from here is a legitimate one. My honest assessment is that the balance of risk is not as symmetrical to the downside for silver as it might appear at headline level. The sellers who were going to sell have largely sold. That does not mean silver cannot go lower. It can and may. But the magnitude of any additional decline is likely constrained relative to what has already occurred. The practical implication, the downside risk in silver from current levels, is probably bounded by the support zone in the $60 to $64 range. The upside, once this correction fully resolves, is substantially larger. That asymmetry is worth understanding, even in a period of near-term caution. The underperformance of gold relative to equities over the past several weeks has a clear explanation, and I want to address it directly because it is driving some of the near-term headwinds we are experiencing. Risk assets have rebounded. The stock market has made new all-time highs. Oil has recovered. Interest rates have moderated. Across the board, economic optimism has improved relative to where sentiment was at the lows several weeks ago. In that kind of environment, broadly rising risk appetite, equity strength, commodity recovery, money rotates toward the assets that benefit most from economic optimism and away from the defensive characteristics that gold provides. Technology stocks in particular have bounced hard. Given that technology represents a dominant share of total equity market capitalization, when technology leads, it absorbs a disproportionate share of capital flows. That capital comes from somewhere, and in recent weeks some of it has come from precious metals. The ratio of gold to major equity indices has retreated significantly from its recent highs and is retesting a key support level, the level that represented 13 years of resistance before being broken. I am not worried about this retest as a structural matter. This is exactly what happens after major breakouts. The resistance converts to support, price retests it, and then the primary trend reasserts. That is the technical structure. What this ratio is telling me in the short term, 1 to 2 months, is that the capital flow dynamic is not favorable for precious metals. Money is moving into stocks, not out of them. Until that flow pattern reverses, gold and silver face headwinds that are real and should be acknowledged. What this ratio is telling me in the medium to longer term, 4 to 12 to 18 months, is the opposite. The 13-year base that broke out is not a signal to be ignored. When the rotation from equities back into real assets reasserts, and the structural case for why it will is extensive, it will not be gradual. It will be decisive. The setup for that rotation is one of the most compelling I have seen. We are in the middle phase. The near-term dynamics favor equities. The medium-term dynamics favor precious metals. Understanding both simultaneously is what allows you to make good decisions at each point in the cycle, rather than being perpetually surprised. Let me address the mining stocks specifically because the picture there has some nuances worth understanding. In the very short term, gold stocks have actually been outperforming gold. This is a consequence of the broader equity market strength. When stock markets rally, mining stocks tend to catch a bid along with equities more broadly. The performance has been real, but I want to be honest about what the candle structure is showing beneath the surface. Several of the recent sessions in the major mining indices have produced what I call distribution candles, sessions where price opened near the highs, traded higher intraday, and then closed near the lows. That pattern, high open, high intraday, low close, is the signature of selling into strength. It tells you that institutional participants are using the rally to reduce exposure, not to build it. The near-term price action looks constructive on the surface. The underlying candle structure tells a more cautious story. Does this mean the miners are about to collapse? Not necessarily. There is probably some additional near-term upside available, but the miners are approaching more significant resistance levels, and the candle evidence suggests that buying power behind the recent rally is not deep. The risk of renewed selling from these levels is real. The indicator I am watching most closely for a signal that this correction has genuinely ended is the advanced decline line for the sector. This measure of cumulative participation has a strong historical record as a leading indicator. It typically makes new highs before the broader index does, and when it does that in advance of a fresh move higher, it signals that participation is broadening in a way that supports the next leg. Currently, the advanced decline line has not made a new high. It is not far from doing so, and if it does, that would be a meaningful signal that the correction is over and the next move higher is beginning. But as of now, that signal has not been given. My read remains what it has been throughout this correction. More time is needed before the conditions that historically precede a durable bottom are fully present. The most productive posture is patient, watching for the signals, not chasing the strength. Let me be specific about what would change my near-term assessment, because this is more useful than a static view. On the bearish scenario, if gold fails to sustain above $4,900 and rolls back toward the prior low zone, that would confirm the analog template and suggest the final low is still ahead. In that case, the $4,200 to $4,850 support zone becomes the area of primary interest, and the setup for the subsequent move higher would be more clearly defined. On the bullish scenario, if gold pushes decisively through $5,000 and establishes that level as support, with conviction in the candle structure and expanding participation in the advanced decline line, that would tell me the correction resolved differently than the historical template suggested, and the next leg higher is already underway. I would not fight that signal. I would update my view. For silver specifically, a sustained weekly close above $81 with the kind of candle structure that suggests genuine accumulation rather than grinding would be constructive. Given silver's relative strength in recent sessions and the amount of price damage already absorbed, the upside scenario for silver may arrive somewhat earlier than for gold. For mining stocks, the advanced decline line making a new high before the broader index does would be the clearest signal I track for sector health. That signal, combined with breadth indicators compressing toward the oversold levels that have historically preceded major rebounds, would represent the conditions I am waiting for. None of those conditions are present today. Several of them are closer to being present than they were a month ago. The direction of travel is right. The arrival is not yet here. Let me bring this back to the principle I opened with. Being careful is not the same as being bearish. Being careful means having an honest read of where you are in the structure, what the near-term risk is, and what you are going to do if the market develops in either of the scenarios I have described. Gold and silver are in a structural bull market. That has not changed. The correction is part of the process, not evidence that the process has broken. The medium-term and long-term case, the one built on capital flows, on ratio structures that have been building for over a decade, on the macro environment that continues to develop in favor of real assets, that case is intact. But the near-term picture demands respect. We are in a resistance zone. The rally from the lows may be approaching its near-term limit. The historical analog suggests the possibility of one more leg lower before the durable bottom is established. And the candle structure in the minors is not telling me that aggressive accumulation is happening right now. Be careful. Watch the levels. Watch the advanced decline line. Watch what price does when it reaches resistance. And remember that in a secular bull market, the investors who make the most money are not the ones who are always positioned. They are the ones who are positioned at the right times and patient at the wrong ones. The right time is approaching. It is not quite here yet. I want to hear what you are watching most closely right now. Leave it in the comments. And make sure you subscribe to the channel so you do not miss the update when the signals I have described begin to appear. I will be covering it in real time. Thank you for watching. Peace.